Suppose prices are constant for some period of time. That is, the rate of inflation is 0. We define money as currency plus checking account deposits. What factors determine the demand for money? Demand for money depends upon national income or per capita income and upon the average interest rate prevailing in the economy. Therefore, demand for money can be shown in a functional equation form like this. Y represents the national income. T. R is a fraction. We assume it is 0.25. So, TRY is equal to 25% of income that people hold for transactions, in the form of currency or demand deposits. In terms of macroeconomics, TRY is transaction, demand for money. It is the portion of the national income held as cash or demand deposits to facilitate everyday transactions.
Second term of the money demand equation is about speculative demand for money or liquidity preference. Money is held as store of value. This is interest rate sensitive demand. If interest rate increases, people may reduce speculative balance of money by investing in other interest-bearing assets like bonds and stocks. Liquid P is interest rate sensitive parameter. We assume it is 55, which means that if interest rate R increases by 1%, speculative balances reduce by 55 units of money. Let's generate national income data. We want to work with 10 income levels, starting from 500 units of currency, increasing with hundreds, till 1400.
Here we solve 10 money demand equations, one for each income level. They are transformed so that we can measure interest rate along y-axis. This is the plot of 10 money demand equations, one for each income level. These are negative relationships between interest rate and speculative demand for money, separately for 10 individual national income levels. Central bank controls the money supply, and we assume it is 80 units of money. Units could be millions or billions of a currency.
Here we add graph of money supply vertical line, at the level of 80. It intersects 10 money demand curves, giving us 10 pairs of interest rate and national income levels. Here, we can see the intersection points of money demand and supply, one at a time. For example, at this point where interest rate is 3.55% and national income is 1100 units of currency, money market is in equilibrium, with both money demand and money supply equal to 80 units of currency.
Here, we extract 10 equilibrium interest rates. When we plot these pairs of points and connect them, we have the LM curve. It can be defined as locus of points of interest rate and income where the money market is in equilibrium. That is, money demand is equal to money supply. We can also solve for LM function in its generalized form as shown here. Here we plot the LM function. Here we show our 10 points on the LM curve.